Record high housing prices might be fueling homeowners and real estate investors' hopes for brighter days in 2021, but experts are alerting that some dark clouds are ahead for the U.S. housing market. The unprecedented demand is being prompted by the growing work-from-home professional landscape and the inability to travel, which have resonated in record-high property sales and in a significant pricing bubble that's already being registered in several major cities across the nation. However, the unsuitable price increase could lead to a more dramatic decline when the housing market crashes. And in today's video, we're going to show you by the charts how the U.S. housing market has entered the most splendid bubble in history. And when it bursts, it could make 2021 the most devastating year to buy homes in America. So stay with us. Don't forget to give this video a thumbs up, share it with friends, and subscribe to our channel to keep updated with the next chapters of the economic collapse. According to the Case-Shiller Home Price Index, nationwide, the prices of single-family houses climbed 8.4%. That's the biggest year-over-year increase since March 2014. The index is based on the sales pairs method, which compares the price of a property that was sold in the current month to the price of the same property when it was sold previously, going back decades. As compared to the National Association of Realtors House Price Index, which is as a function of median prices, prices jumped 15%. Amongst the main drivers for this considerable spike in prices is the reduced housing supply and the record high demand, as well as the extension of mortgage deferral periods. By contrast, related to all the previously mentioned, high unemployment rates may reverse both elevated prices and supply shortages. At this stage of the crisis, the bleak economic outlook for the forecasted 20 million out-of-work Americans might force unemployed owners to sell their homes, increasing supply and keeping demand for housing down. But one factor that has been keeping the market afloat is the record low interest rates, since borrowing has never been so inexpensive, which of course fuels the demand for housing by making mortgages more affordable. The Fed has been constantly handing trillions of dollars to the markets to keep rates down, ignoring the massive bubble the market has entered and the consequences of it on the debasement of the dollar's purchasing power. Moreover, the shift to working from home arrangements and the popular preference for homes over apartments or condo towers, as well as a dose of panic buying, have also contributed to keeping the housing market heated. As Wolf Richter reported in Wall Street, several major U.S. cities are registering skyrocketing prices, with Los Angeles having the most splendid housing bubble of them all. In LA's metro area, house prices increased 1.1% from September to October and 8.4% year-over-year, which means prices are 14% higher than they were during the 2006-2007 bubble that resulted in the previous housing market crash of 2008. In January of 2000, the Case-Shiller Index was set at 100 across all 20 cities it covers. Now, the index value for Los Angeles is 312, meaning that house prices in the metropolitan area have more than tripled since January 2000, almost 212% up, the biggest bubble nationwide. The latest release of the Case-Shiller Home Price Index, named October, compiles a 3-month average of closings that were entered into public records in August, September, and October. The index also provides sub-indices for some cities. For Los Angeles, besides overall house prices, it also provides data on condos and for high, mid, and low-tier house prices. As we can observe, prices in the low-tier segment, which are represented by the black line, climbed 10.4% year over year and have almost quadrupled since January 2000, setting an increase of 281%. During the bubble of 2006-7, or as Richter dubbed it, Housing Bubble 1, this same segment recorded the biggest jump. Conversely, during the burst, it suffered the sharpest collapse of nearly 56%. As for high-tier prices, which are represented by the green line, it was recorded an 8% increase year over year, and now the segment is up 188% from January 2000. Condo prices, represented by the red line, rose at the slowest pace of the four categories, approximately 0.5% month over month and 5% year over year. In San Diego, house prices have nearly tripled since 2000, 193% up, and in October from September, prices jumped by 1.7% and by 11.6% compared to the same time last year. As for San Francisco Bay Area, in the counties of San Mateo, Alameda, Contra Costa, and Marin, the Case-Shiller Index rose 0.9% in October from September and grew 7.7% from a year ago. From the peak of the Housing Bubble 1, the index went up by 50%, and it almost tripled since the year 2000. However, despite the all-time record condo glut in San Francisco itself, condo prices in the five-county Bay Area dropped for the fifth month in a row and declined 2.3% from a year ago, below where they'd previously been in March 2018. Seattle's metro area has seen housing prices increase by 1.1% in October from September and 11.7% year over year, having soared 47%. Contrarily, in New York, since Manhattan's condo market has been undergoing a reckoning, the Case-Shiller Index for condos has practically flat-lined since late 2017, and it's slightly lower year over year and from the peak in October 2018. In cities like Miami, prices went up by 1.5% in October from September and by 6.8% year over year, but retracting 6.1% of its staggering peak of Housing Bubble 1. On the other hand, Washington, D.C. has recorded a rise of 1.3% in October from September and a jump of 8.2% year over year, and in that way, it has even surpassed the peak of Housing Bubble 1. The report also highlighted that in Portland, Boston, Tampa, Denver, Las Vegas, Phoenix, and Dallas, price surges in the range of 1% in October from September and in a 7% average year over year were also registered. In essence, as Richter explained in his report, the Case-Shiller Index tracks the number of dollars it takes to buy the same house over time. Thereby, it measured the purchasing power of the dollar in relation to houses. That's why it is considered as a form of measuring house price inflation. And what all of those charts have shown us is that the dollar has lost its purchasing power with regards to houses at the fastest pace ever. Evidently, the Federal Reserve's quantitative easing policies have largely enabled this deterioration. In a recent article, Zero Hedge has exposed that in spite of the Case-Shiller data that suggested the fastest surge in years, Fed Chair Jerome Powell seemed unconcerned about the recent increase in home prices and stated the following during a question and answer session. He said, "I would say from a financial stability standpoint, housing prices are not at a level of concern right now. That's just reflective of a lot of demand, and buildings are going to bring forth supply. Housing prices themselves are not a financial stability concern at the moment. We will watch that carefully, but in the near term, I wouldn't think that's an issue that we'd be concerned about." Needless to say, experts completely disagree with this lack of concern, particularly because, as the following statistics and charts from Goldman reveal, the trillions in newly created liquidity have ended up straight into the housing market. But before presenting the charts, some other considerations that point out the extension of this massive bubble can be seen in the 100 basis points in 30-year mortgage rates between Q4 2019 and Q4 2020. Currently, 80% of outstanding conventional 30-year mortgage borrowers have a 50 basis points or larger refinance initiative, a jump of 50% compared to Q4 2019. Additionally, agency MBS issuance year-to-date has totaled $2.8 trillion, 2 times higher than last year's, and the Fed MBS holdings have increased by $800 billion over the past year. Keeping that in mind, by analyzing Goldman's housing activity tracker, the enormous spike seen this year clearly indicates we're in the middle of a bubble. But if that's not enough to convince optimistic investors, the following charts illustrate how pretty much every data series is experiencing a V-shaped recovery. And as demand skyrockets, prices are inevitably driven up since supply is plunging. The same way as mortgage rates, which have hit rock-bottom records time and time again last year. Of course, that comes as a consequence of the Fed's MBS buying spree, purchasing over $100 billion in mortgage-backed notes just in November. Meanwhile, despite the tightening in lending standards, getting a loan remains relatively easy. But as prices keep soaring, fewer people can afford to buy a home. As a record of 34% of young Americans are now living with their parents, even with household formations on the rise. Consequently, that forces younger workers to rent. But as many of them are returning to their families' homes, that has pushed the rental vacancy rate to all-time lows, especially since other age cohorts have been leaving cities by the millions and preferring to risk buying a house, leading the homeownership rate considerably up. Although such high prices are ultimately unsustainable, the latest stimulus injection indicates that the ratio of household financial obligation payments to disposable personal income is at an all-time low. The same goes for the debt service ratio, mostly thanks to record low rates. Likewise, the fact that so many Americans are still delinquent on their mortgage payments is yet another factor pushing prices up. Therefore, between the decline in supply, the surge in demand, and the stimulus-boosting injections, the results seen in prices can be illustrated by this chart, which shows the median prices of new and existing single-family homes is at or near all-time highs, which has plunged the percentage of mortgage properties with negative equity to the lowest ever recorded. At the same time, the annualized QQ home price appreciation is the highest since the financial crisis. So, between the Fed's record low interest rates, Congress's fiscal stimulus package, a huge debt-fueled demand, and record low supply, the housing market is now much hotter than it was during the apex of the 2006-2007 housing bubble. And it goes without saying that this also means it's now set for a much larger crash. This is the world's biggest asset bubble that we're talking about. And Powell's statements show that the Fed doesn't have any plans to properly address the unsuitability of the housing market, which has been proven in each and every one of these charts, which leave us wondering what will effectively happen to our economy when the collective bursting of both the biggest stock market and housing bubble occurs at the same time. It seems that we're headed to a major financial catastrophe. And at this point, and by the size of the damage already done, there's no escape.